I was talking with a kind of a friend and colleague who trades a lot of these FANG stocks and options, and he's a pretty large trader, a couple hundred contracts a trade. So he's definitely has some clout with his decisions, and he has the ability to sometimes manipulate contracts and see things really change. But last week, we talked about doing a trade, kind of wanted to bounce this off of me to see what I thought. And I really was like, that's kind of interesting. I didn't really think about doing that. But last week after earnings for Netflix, the July 23, I think it was on Tuesday. Yeah, it was Tuesday. The stock was at $85 roughly. So after earnings, stock got hit. There's 3 days left in the week. He's like, why not sell the 90-50? He sold the 90-50, which doesn't really matter. But all right, now that I got all my facts right. So it was 719. This spread for July 23 could be sold. I was looking at selling it for 225 to 230. And that's a very accurate price. So basically, in essence, you're selling this credit spread to where you're risking $20 to make 230. It's like a 20, it's like a 10 for one or potentially a 20 for one, depending on your fill credit that you can receive to sell an in-the-money bull put spread. So the reasoning behind this is that it doesn't really tie up any margin, because you're getting a credit that's so large on a risk that's $2.50. You're getting a $2.30 credit to where after earnings, on which it worked out. I said, why not go out to this week? So this was definitely the week to do it for timing reasons. But the whole thought process is after a big move lower, you're probably going to see kind of like a dead cat bounce and see it slowly fill the gap. So that's definitely what happened today. And I think this is a strategy that can be replicated on a lot of these names this week after earnings comes out. It is taking the contrarian standpoint and seeing what happens, let the dust settle the day after, and then maybe late morning after the report comes out and you see that you have a base set in, is putting on a trade where you're selling an in-the-money put spread if it's bearish, if the stock moves lower, or an in-the-money call spread would be the same thing if the stock went up a lot, like for ISRG would be a good example. But this one right here, this credit is very large for that risk. So if you did 10 of these, I can just tell you off the top of my head, to do 10 of these, you're risking $200. So even though the buying power, it's a $2,000 risk on 10 contracts, this example, the most you could ever lose is $200. That's the defined risk mechanic, because you're bringing a credit of 230. So risking $200 to make potentially 2,300 is insane. And this credit is 230. This is actually, let me keep this accurate at $1.95, because the 230 credit was when we did the 90, 250, 90. That's a perfect example as well, is looking at a $2.50 risk to where you're getting basically a credit of 240. So now the same example, you're risking $100, right? Because you have a credit of 240 and the most you can lose is 250 on that spread. So that 10 cent risk, my head's going back and forth looking at the screens for earnings. Apple's not doing anything. It's up 2 cents, which means it's not coming out till 4:30 probably. Buffalo Wild Wings is down $3, which I don't know what that means yet, but not too much activity right now. This strategy, though, I think is something that I might even broadcast out this week on maybe Google or Baidu or Facebook, perhaps, on some of these larger names that are coming out. Doing something similar to this, there's a lot of truth into this, because the risk is so low to the potential reward. It's this whole entire business of trading. It's all about managing risk and putting on probable situations and giving yourself edge and putting on smart strategies that are going to work. This is a strategy that is very interesting because it's such a low risk scenario where you're limiting your downside. It's like an educated bet to where you're risking, and the educated bet with an edge, because we're playing kind of against the market, and there's so much truth to where when you have a big sell-off in a company like Netflix last week, and the most important thing in the strategy is of course the timing element, which is why we have to look at that next. But for risking this exact trade, which it didn't work out last week, to point out, because if we look at the outcome, if we got this move today, last week on this, then that trade would have made a fortune. And my friend, he put on like 100 and something contracts. So it was like risking, and he didn't get a 240 fill. I think he got filled like 220 something. So he was risking, I think it was, I don't know, $2,000 to make 20 or 25. It's a trade that is very, very interesting to discuss and analyze. So what I liked about this trade was going out to the July 30 options and getting a credit of about 225. So this is the trade, by the way, and this is the example of where and why I like Leap so much, and going out that extra week and doing this same exact strategy. Yes, it's a little more risk. So for this example, instead of risking $100 on a 10 lot, you're risking 250 or 280, call it. I think it's safe to say you can get filled at 225 here. So say you're risking $250 to make a max profit of 2,200. I think it's even safer to say that you're most likely going to close this out for a debit of like $1 and basically risk 25 cents to make a profit of $1 contract or something like that, which is a 4-for-1. These are strategies that are very powerful to discuss and to teach. And because when I teach this stuff, I get more fluent with it to where I can become better and make it a win-win. So Hemphy said, in the money bull put is for bullish trade during after earnings. So for this to clarify, Hemphy, this is a strategy that's specifically done after the event. So after you have the news come out and you see a stock trade lower, there's a lot of back testing and proof to where, say, a stock gaps up, it kind of pulls back a little bit, people take profits, happens time and time again. Like last week, Netflix stock gapped hugely lower, and now it's traded up from, I think it was hit a low of 85 a share last week. Now it's back up to 91. So this is something that is done post earnings to give yourself that kind of that margin and that edge to where you can trade back up and limit your risk with having a huge credit that gives you a payout. So yes, John, this would be something that you put on after a move on earnings and after you see a solidified base that's formed. I'm looking over at Buffalo Wild Wings. It's trading up $6 just for a little update. So now, like the thing that I want to show you now is, what is this? I mean, it's like that. What is this trading for today? So when I was talking to my colleague, and I was like, that's a really interesting strategy. I like that. I think this week, meaning last week, is kind of a little too short of a time frame. But why not go out to the July 30th? And he had something to say that he didn't agree with or whatever. But for me, and for this strategy to actually utilize and showcase and trade with you all, if we did this trade, which I almost put on, I should have, and I'm definitely going to do one this week on one of these names that come out here that's a high flyer like Google or Facebook or maybe even Apple, is to sell the expiration for the July 3rd. So this right now, you fast forward a couple days and we can look at this. So this is Buffalo Wild Wings trading up to 152. See what Apple's doing. Apple is exactly flat. So that's coming out in about 15 minutes. So now what is this trade that we're looking at? Selling the 92.50. Guarantee you it's probably like $1.30. Buying the 90. I mean, so this is an example where, and I know I'm going a little bit fast and I'm a little back and forth here, but last week you have a Netflix, it hits the base. So after earnings, you remove the risk of not trading through this event. The event happens, you hit support, which you can see very vividly if I zoom out a little bit, hitting a strong support level. That base holds. Normally you can streamline into a short time frame, like a 30-day chart, to where you can see it hold. And then when you're starting to trade slowly higher, like as it goes up to 86, maybe you see that formed bottom to where you have that that confirmation to go into this trade. So this is the example, doing this on the day after earnings for this week, July 30th, selling the 92.50.90 vertical put spread, which is in the money by about $5 or $6. So, or if the stock's at 86, or we needed to go up to 92.50 to make a max profit, it's about $7.50 in the money. So on a day like today, when the stock goes up $4, this position can be bought back for $1.20. So if you did 10 of these, right, and you got filled last week at 225, it's pretty easy to see, but 225, and now when you can buy this back for less than $1.20 or so, maybe even $1.15, you basically make yourself a quick $1,000 or $1,200. And the risk, which is the most important part, if I put this on last week, the max loss, $250. Max profit is 10 times that almost. So when you define your risk and you limit your downside, like this strategy, define risk trading is what we're all about here, you're going to be setting yourself up. And it only takes a couple of these to really hit it home run. I mean, if you can risk $1,000 and say for this one you do 40 contracts, and you're risking $1,000 to make 9,000, you can buy this back as a debit today, which is the inverse, for basically $5,000. So you can make yourself, it's scalable, but you can make yourself $4 or $5,000 by tying up $1,000. It's a 4-for-1 example because you're basically risking 25 cents on that spread, which is the differential between your credit and the spread width. So on the analyzed for this trade that we're looking at, the max risk, which I can see very quickly, and I know if you're just learning this and digesting this information, this might be confusing, but this is defined risk. That $2.50 spread is the most you can lose, would be $2,500 on a 10 lot. For one lot, it's going to be $250. When you're bringing in $2,250 against that risk, that shows you that your risk here is $250. When you can buy this back for a debit of $1.20, then you're going to be able to have a very, very profitable situation. Ken, I just saw your camera come in here. It's great to see you. Looking sharp, my friend. And let me know if you have any questions there. So John said, you put this on after earnings. Yes, that's correct. And normally like the day after, could be 2 days. It depends. John, I'm glad you're on here, my friends. John's another coaching client of mine, and him and I have a closer relationship, which just makes me laugh because Twitter, he just said, got smoked, and it's trading down to $16. So that's an interesting one to talk about. Very interesting to talk about. So that could be a good example. I think this would probably be a little less attractive doing Twitter because it's a lower price stock. And on this example, it's a little sexier to have a higher credit, higher price stock. On Twitter, we can look at this, but I think there might be better ones this week on Google, or Facebook is a good one. If Facebook misses, that could be a great example. But yeah, this is kind of what I'm thinking about is getting new things in the Rolodex for us so that we can have a multitude of strategies to pull from and not be too, just seeing what Apple's not out yet, and not being too reliant on the same thing over and over again. So Apple's flat. Buffalo Wild Wings is trading slightly higher at 150. But this is something that you can see for right now, like on Netflix. Like if I had this position on last week and I got a credit of $2.25 and now I can buy it back for $1.20, you would definitely want to scale out of this. But if the stock's trading today on Netflix, we're talking about now, it's this example, is trading at 91, I think, 91.45. So if it goes up another $1 tomorrow, or between now and Friday, or tomorrow and Friday, this could collapse. And you're really not, you're using the the premium side, you're using all these things where you don't have to have a huge movement. It's just got to slowly inch higher. A $2 up day, you can probably buy this back for like 30 cents. So that's a little food for thought for you. As far as the next example, I'll be on the lookout for sure. Thank you all so much for your time. And if you need any help with anything, just shoot me a private message or email inside the club, or chime in on the group chat that's not too in depth, and I'll be in touch. So have a wonderful rest of your week. Trade smart, keep at it, and take care. Thanks so much, guys.